This demand alone is sufficient to power gold into the 33 to 3500s just on its own.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Morand, and I am thrilled to be your host for this week's episode. From the entire Live from the Vault team around the globe, we want to extend our heartfelt thanks for your unwavering support. So thank you so much. As you might imagine, our community is expanding week by week thanks to you, and we couldn't be more excited about that. So all right. With a big welcome to our first-time viewers. Welcome to Live from the Vault, and we're in the midst of historic times here. And today, we've got the one and only Andrew Maguire in the vault, and our very own precious metals expert whistleblower. And he's here talking gold. So buckle up. This is going to be an exceptional episode of Live from the Vault. You know, Live from the Vault brings you weekly exclusive insights and updates that you simply won't find anywhere else. And this episode right now is no exception. But before we dive into talking gold with Andrew Maguire, let's just take a moment to keep spreading the word about our channel. So please hit that like button if you haven't already done that. Share this information and this video, and don't forget to hit that subscribe button if you haven't already subscribed, because your support really helps us reach more and more people with this vital conversation here that we're having. So if you want to be notified every time we go live, make sure that you click on that black bell right there, and we will do just that. So all right, hit the like button right now. And without further ado, let's cross over to the UK for some in-depth gold talk with the one and only Andrew Maguire. Hey, Andrew, right at the beginning of our last episode, which we recorded, it seems much longer, but only on the 19th of March, you said that you were once again happy to go out on a limb and what we should expect from gold and silver into the second quarter here. This new quarter just began a couple days ago here. So you pointed out that the paper market that was imploding and was irreversible, that a real physical gold price is about to emerge, the real physical gold price, and it has a long way to go. That's what you said. So for consistency, can you up the thread from our last episode that we recorded on March 19th?
Hey, Shane, great to be with you. Great to be with everybody. I can't believe it. These 2 weeks come around so quick. So following a second consecutive, extremely bullish, and I will emphasize, physically driven upside breakout week, it was inevitable that spot gold and gold futures as well would have to break up into all-time highs. And while I expect our minimum 3,500 target to be easily achieved, on a shorter-term basis, we'll review the feedback from our first-tier liquidity providers to gauge what to expect as we settle into this first month of the second quarter. So with that in mind, let's look at the elephant in the room, and it has really very little to do with tariffs. The gold rally is physically driven, and while for the duration of the first quarter, we've continued to experience this slow but steady series of Asia buys physical, US sells paper gold sort of mantra, it's resulted in a series of higher physically supported stair steps being established. But it's the concurrent race to repatriate US gold ahead of the 1st of July Basel III compliance that has really driven the end of the first quarter breakout. And the bullion banks can no longer hide their betting on much higher prices.
So this brings us to a very, very quick look at the charts, just to illustrate what we're talking about. Now, just to say, this is where we recorded the last episode, and it's always between the AM and the PM fix, usually between the AM fix and the pit open. And this is where we've just had an AM fix a short while ago. It's 2 hours ago, actually. So it's currently heading towards the pit open today, the New York pit open. So just to say that's where we are, so you can put things into context. And here's the spot daily chart. So the timing, so we're just talking about these much better high prices. The timing couldn't be worse for officials, as this breakout ahead of the first quarter benchmarked officials having to repatriate their Bank of International swaps and leases here $300 higher than the Fed's last BIS swap repayment on the 28th of February. And this happened on Monday at spot 31.27. Now we know that it's the Fed, as they're the only global central bank still trying to manage the dollar price of gold ahead of the 1st of July deadline. Nobody else is borrowing gold to sell it into the market, knowing they're going to have to buy it back. This is a capping attempt. Now, many of you trade the futures market, so essentially this is the same thing. This is where, again, $300 higher. It's actually slightly higher because this is where the new June contract came into play, and there's always a carry premium. So obviously this contract, June contract, expires at the end of May, and so currently it started off about $32 premium to carry this contract to the end. That contracts to zero as we get to the end. So currently it's about $27 difference. But just to illustrate, and this is really, when you think about it, this is just one more step higher. And our liquidity providers report very strong incoming safe haven tariff-related Western fund demand as well, seeking to gain long-term exposure to the single best performing asset class, which is gold. Now, this is a quarterly chart. And so really what we're seeing is the concatenation of US and global NSFR compliant gold demand got the commercial spooked into the end of the month first notice, followed by the commencement of April gold futures deliveries, which have now begun. So you can see the quarter finished right at the top of the range. So I'm going to look at these unprecedented large deliveries shortly. I'll dig down into the more granular detail, as this multifaceted drain on tradable COMEX gold was not foreseen and is unstoppable. It is this wall of physical and ETF gold buying competing with official US gold repatriation demand that drove several bullion banks, including Goldman, to upgrade their spot gold targets to between 32.50 and 35.20 in 2025. However, they also view a potential for a run into 4,500 to follow by the first quarter of 2026. Obviously, there's a lot of unknown factors here, but these are not hollow statements. Goldman is one of the first tier liquidity providers that we talk to on a regular basis. And as you know, they've been long and strong for a long time.
It's notable that these 2025 targets, which are first tier liquidity providers, including Goldman Sachs, have been sharing with us here since January, they're now being openly shared publicly. And as we know, these bullion banks have been long and strong for their own books since the Bank of International Settlements short covered all of their swaps and leases on the 1st of November 2022. We looked at that closely on the charts last time. And these banks have now stepped up accumulating gold for both their house and their client accounts. And this is ahead of US Basel III compliance on the 1st of July. Now, these repatriations have to be concluded before the end of this second quarter. And do remember that we've been reporting all through this first quarter very, very large official size Indian and Chinese demand all through the last few episodes. And that these preceded these rash of bullion bank upgrades, which they've all come out pretty much to concur that prices need to rise. Now, with the cat out of the bag, Chinese institutional demand, which has up until this week been waiting for an end of month, end of quarter pullback because they're usually rewarded for it, they've also now stepped up buying ahead of anticipated higher prices. And this includes, as yet, untapped pension fund demand, which liquidity providers reported began picking up on Friday. And this untapped pension fund demand alone, and we went through the details of it a couple of episodes ago, this demand alone is sufficient to power gold into the 33 to 3500s just on its own without any other input.
All right, Andrew, there's been a lot of speculation about the unprecedented COMEX deliveries that you just referred to. Can you give us your take on what's really going on here?
Yeah, from time to time, we get a perfect example to study as it really identifies the various actors' footprints and how this paper to physical gap is actually fast closing ahead of the 1st of July Basel III compliance. Let's look at the end of the COMEX first quarter COMEX data, which was published. There's a lot of speculation around the one-day 141-ton inflow of April gold futures, when from a historical perspective, it should be draining because this contract is already in process of being delivered. Now, according to the CME data, this sudden inflow translated to an unprecedented 108.44 tons of immediately delivered gold. And while we evidenced around 10 tons delivered on the first day of the second quarter, as of today, it still leaves 50 tons to be delivered. Now, all of these changes in the reported registered April gold stocks, the gold bullion stocks, that is, COMEX stocks, occurred into a complete April gold stock reduction of 273 tons. So 273 tons came out through that this April contract. Now, given that less than 62 tons rolled into further out June contracts, so that in other words, you have the choice of rolling these bets further and further out, and June would June contract and beyond. It really didn't, and which is the contract we're in at the moment, and it didn't really have to be fully paid up when you do that, and it's still left a massive discrepancy as to where these so-called deliveries landed. So here's what we see. Now, liquidity providers estimate that out of the 108 odd tons that were loaded out of the COMEX registered open interest, that some 50 tons flowed into the US dealers' hands to short cover exchange for physical shortfalls. In other words, the EFP shortfalls where you bet, you have a short position to hedge a long position, and it's usually asymmetric in the sense it's not one-to-one. So you need to cover those off when you've got a rallying gold price. And while the balance of this 108 tons is almost certainly related to official US Treasury gold repatriation efforts ahead of this end of second quarter compliance on the 1st of July. So there's a race. Now, because foreign exchange gold is Basel III compliant and that the COMEX EFP mechanism has to allow, remember we call it the Achilles heel, the COMEX Achilles heel, because it has to allow for the conversion of a fully paid up COMEX position to be translated or to then be settled in a physically backed bullion in Loco London on a T+1 delivery basis, meaning it has to be physically delivered on a T+1 basis. And that the locked in foreign exchange price at the global facing daily gold fixes, which is where gold is benchmarked for delivery, they've already, because this COMEX price has already influenced, because it's fractionally backed, it's already influenced the daily price. And so the COMEX futures market price is then locked in to a partially diluted COMEX price at the fix. And there's no need, because it's Basel III compliant, there's no need for a global facing central bank or sovereign and the large institution traders. Why would they incur the additional friction and additional shipping costs to take physical delivery of this bullion, local London and Switzerland, etc., when they have that mechanism available to them much cheaper? This indicates all of the backdoor loadouts. These are the deliveries that face the US entities. And keep in mind that some 125 tons of April lots had already been EFP'd for physical delivery during the course of the April contract span. And it is that this plus or minus 125 tons of registered COMEX gold that has been forced to exit into this net stable funding ratio regulated compliant T+1 physical delivery at the AM and the PM fixes. And as we know, it's these fixes where central bank sovereigns and large institutional actors lock in the global facing deliverable auction price, because it's an auction price. So FX Gold Basel III compliance enables them to alchemize the COMEX influence price, and it's job done. Thank you very much. However, a Western-facing LBMA bullion bank acting as an agent for the Fed, and we know they do, and they act through the Bank of England, and the Bank of England is demonstratively dragging their heels to deliver Bank of England gold into supply shortages, and we did a lot about this in the past, because they're and we questioned, why are they unable to make timely deliveries of 400-ounce central bank monetary gold demand when there it is, supposedly in the vault, ready to load out, meaning these related officials may actually be forced to air freight bullion to meet this demand. And this comes to light when one looks at the Fed's borrowings of the Bank of International Settlements gold, which since March 2024 at $2,000 has been forced to sequentially repay these underwater leases up to $1,100 higher per ounce, because they never fully did. While the Bank of International Settlements cleared all their swaps and leases before Basel III compliance on the 1st of January 2023, the Fed kept borrowing. So what it means is these leases have to be bought back at a series of higher market prices, and they haven't fully exited these positions. Now, obviously, this whole paper to physical process will continue to play out, and there will be ebbs and flows, but these paper market actors are increasingly being forced to dance to the physical market undercurrents.
Now, Andrew, you also mentioned that silver will be a major beneficiary of the gold breakout. Where are we in this process?
Well, multiple years of sustained LBMA cartel silver capping has successfully tricked out the majority of silver investors, and which leaves very little speculative open interest, casino chips, for the LBMA silver cartel to rinse out as short cover fuel. In other words, if you're going to short the market, you make sure you can lay that off on someone else. So if there's much fewer of these speculators in there to lay it off on, that's a problem. And what this indicates is they are running out of enough paper silver to offset an increasing volume of backdoor COMEX loadouts. And a backdoor loadout means previously ring-fenced cartel-owned silver that usually circulates within this casino and doesn't exit. It exits the COMEX vaults on a one-way journey to fill global orders for silver that is priced well below bullion available for immediate delivery. And bearing in mind that every other FX currency, silver's broken out in every other FX currency, yen, Canadian dollar, I mean, you name it, it's broken. Aussie, it's broken out. It's made new highs. So as a consequence, silver is coiling for a very large move through low-hanging short stops at spot $35, which is why the cartel are synthetically expanding the short leg of the exchange for futures leg to try and defend these spot short stops from being ignited. We'll demonstrate that in a minute. It's not realized yet by sideline silver traders that silver will be the major beneficiary of US market Basel III compliance and is expected to significantly outperform gold as we move forward. Now, liquidity providers indicate that the cartel's critical upside breakout level is very low hanging, just above spot 3,500. Spot silver is ready to breach these short stops. So let's pop in on the charts to illustrate what's going on.
So here we are looking at spot silver, and we're looking for clues for the breakout signal when the massively expanded exchange for physical spread starts to contract at $35. Now, there's been a massive attempt to block very large short stops, cartel short stops, from being breached at $35. So let's go through what we're seeing. And as we noted last time, there's a slew of impossible to hide bullion bank expectations of significantly higher gold prices. And that telegraphs that it's going to be impossible to protect very large legacy cartel silver short stops from being ignited. In fact, they look magnetic. And it was clear the cartel was trying their utmost to double down in a last-ditch attempt to protect these spot stops at $35 from being ignited. So let me show you the desperate attempts that they're doing now to stop 35 spot from being breached. Now, technically, gold should be above, spot gold should be above $35 because spot gold is currently at $33.94 because the cartel has expanded the short leg of this exchange for physical spread to around 80 cents. I mean, it's currently at 80 cents. Now, that is huge. And it's been as high as $1.10. And of course, this is actually occurring into strong Chinese buying. And this was happening into the end of the quarter. Now, there's an arbitrage going on here, and it's not being understood by many people. So, as I say, as we record this on Wednesday, after the gold fix, after the silver fix, actually, it's still around 80 cents. Now, there's only 3 weeks for the May contract derivative bets to be marked to market at the end of April. And this is that contract that is about to expire. Now, so this May contract has to be marked to market at the end of April. So fair value for this EFP spread should be about 13 cents, not 80 cents, not $1. I mean, this is ludicrous. Liquidity providers are busy arbitraging this discrepancy for their clients, which suggests silver is very, very close to breaking out. So while it looks capped, and this is the breakout level for futures, while it looks capped, it's synthetically capped. And Chinese, Indian, and our liquidity providers are telling us this spread is being arbitraged aggressively. And these stops at 35 look magnetic to be breached. So it's not going unnoticed that this EFP spread should be 13 cents at this stage of the contract. So while this risky synthetic EFP exchange for physical expansion has so far successfully blocked spot 35 from being tagged, and obviously we have that high at 34.85, so it was successfully contained last time, but it's a wholly different structure now. So liquidity providers read this disconnect as very arbitrable. And I just wanted to make that point, and is being jumped on by Indian and Chinese buyers. Last Monday, silver evidenced the highest fix since the 29th of October. And that was here. And this was the last time we saw that fix at these levels. But in this case, the EFT spread was not expanded, and certainly wasn't expanded to over $1. In fact, it was $1.10 when this fix was established. So really, silver should have been closer to 36. And we expected a fight. And there's a lot of wrong-footed, naked short official, that's the OCC bets. Remember, we talked about the Office of the Comptroller bets. And these are FX bets against silver, which they had to be marked to market this Monday. But as these bets against silver are in the hands of officials and can ultimately be cash settled, albeit at significantly higher prices, it's understandable as to what's going on and who's behind this. Cash settled or physically repatriated, it will drive a higher global silver price. There is a distinct smell of blood in the water. And for the first time since the commencement of the $18 COVID rally, post-COVID rally, basically silver looks coiled right now for the commencement of a repatriation short covering rally, and this time with almost no speculators on board to rinse out. Now we're looking at the futures contract here. And again, there should only be a 13-cent difference. So really, if you think about it, 35 should have easily been taken out. And here are these actors in play, blocking that happening. But they're digging a hole. As I say, this is unprecedented given the lack of specs to rinse out thereafter. So liquidity providers anticipate these short stops above spot 35 are looking vulnerable for a quick gap move into the 38s, which would be sufficient to bring in the sharks for a run at 50. Also, as US markets become Basel III compliant, the recently published Bretton Woods OCC stablecoin interpretation will force compliance of FX derivative silver and gold. Now, we've reached the stage where it's getting very risky shorting silver into a 4-year and growing supply deficit and very strong Chinese and Indian demand. And while these spreads are volatile as the fight plays out, narrowing spreads at spot 35 will be the signal for an imminent upside breakout. And I'll once again draw your attention to this spread should be 13 cents at this point. This is the cartel in action.
All right, Andrew, what are you seeing very short term? Before we started recording, you mentioned something about the NFP, which will be published when this episode is released here on Friday. Has historically been a time when speculators are targeted. What are your thoughts here?
Yeah, Shane, it's always good to have one's eyes wide open, as this can provide us some good opportunities to take advantage of any bargain prices. Now, if you are a stacker, who cares? I mean, you've just been averaging into gold and silver forever and a day, and over time, you're being well rewarded for it. But we do get a lot of questions on this subject, so we will answer them. Now, really, it's just a question of tracking how many speculators have jumped on board, as this is the maximum number of casino chips that can be harvested by the casino pit managers into any contrived synthetic air pocket. Now, these air pockets are created when you're a market maker and you collude. You can just pull the bids. You're supposed to be making a market, but if you pull the bids, then you're not going short, but what you're doing is creating an air pocket. which is what we've been watching, or what we've been experiencing. We went through the detail of that over the last few episodes. Now, what we've been illustrating is that these historical wash and rinse cycles have become extremely muted. Why? Because the gold price is being discovered in the global south facing physical exchanges where you have to own a bar before you can sell it. And any attempts by the casino to rinse out the speculators is really limited to what these pit managers can offset inside the paper markets before it exposes them to physical delivery obligations they can't meet internally.
So in summary, it's not going unnoticed that we've established 23 consecutive central bank size fixes above spot 3,000. This is a futures chart, so the spot adjusted level for that would be about 3,024. So we've had certainly 23 consecutive fixes, and 9 of them above 3,000. And 9 of them above central bank demand at spot 3,050, which would be this level here. Again, about a 25-cent premium, which we have to make adjustments for. And also, we've now had the last 4 fixes have 5 fixes have topped 3,100. So that's 5 times above 31 spot. 31 is 31.27 at the moment. Now, the reason we track both is because one influences the other, and it's the footprints in the futures market that really and how they diverge from the physical markets, as we just saw, and also in silver, that tell us what's going on. The current action evidences continuation of the last 12 months of ongoing physically supported higher stair steps and fresh ones being established. And just a quick note, liquidity providers advise us there's further central bank buy stops to be triggered on a breach of 31.78 futures. So that's where we'll leave it, and we'll have a full update, obviously, in our next episode.
Now, while officials race to repatriate gold ahead of the Doge gold audits, US markets, Basel III compliance on the 1st of July, that is, very short term, these deeply offside derivative bets have been caught grossly underwater. So they will continue to do their utmost to hunt out any freshly added speculator longs to short cover into. And there's always a degree of speculators hanging on for the ride. You can't blame them. The price is riding, your momentum, you buy the momentum, but they are vulnerable. And it's really just how many are there to determine how much of a sell-off they can create it, because there's certainly nobody else wanting to go short. So, but into this mix, these official actors are now having to compete with a raft of fresh fund buyers looking to gain long-term exposure to gold. Now, these fresh COMEX ETF inflows is simply not rinsable. So the idea of getting any dips sub spot 3,000 now has become unrealistic. It's moved up too quickly, and there's been so many fixes above that level that it's actually finding a support level that central banks have just simply said, well, if we want it, we better bid where the most likely worst case scenario is for it to actually get a discount. If not, we'll have to buy it higher. In fact, as we gathered last night, I had a bunch of calls last night around the desks. Liquidity providers assessed that the very large central bank bids that were aggregated at spot 3,000 now look to be re-aggregating at spot 3,100, providing a window for central bank physical support levels to have risen to this level. Now, we're not out of the woods yet, but it looks like it. So bottom line, the bear squeeze continues. So dip buying looks attractive and will limit the scope of any non-farm payroll selling on Friday. It's usually a place where you guarantee to be able to rinse out, hunt out some stops. And what they usually do is the algos hunt out anything static. So if you've got a buy stop or a stop in the market and you're a speculator, they recognize very quickly that it is a speculator one. And you're, in often cases, they'll just tag it quickly before, and if it's big enough, they'll tag it. So because non-stable funding ratio compliant T+1 deliverable spot gold market which is deliverable, and the 96% leverage COMEX future markets greatly influence each other, it's very important to track the short-term paper leg of the exchange for physical spreads. And as this gap is closing, it'll become far too risky to expand the short leg above what can be offset against the non-sticky specs. Now, there may be more cartel attempts to drive end-of-week spec profit taking, as has been the case every single week, especially as we've got non-farm payrolls and tariff action all playing out at the same time. But these efforts will once again run into Asian buyers and fail to gain any meaningful downside traction. And we would expect short covering to kick in ahead of the Monday Asian Open, no matter what happens. Now, the stock market puke has evidenced some margin calls being offset with gold longs, with gold futures longs. However, there's far too much offsetting safe haven incoming demand for these dips to be sustainable. So really, this beggars just one question, and we have to end with it every time. Every single liquidity provider is now unashamedly long. Every single bullion bank is also long. And they're betting it's going to cost more dollars, pounds, euros, yens to buy the same ounce of physical gold and silver, especially silver, now that it's broken out in every other currency but the dollar. So the only question remaining is, how well are you positioned to protect your wealth into this huge reset?
All right. Thank you, Andrew Maguire, for another fantastic episode of Live from the Vault. And remember, to our Live from the Vault community, buy physical and understand the critical difference between what Andrew calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. So there you have it, folks. That's all we got for you today on another episode of Live from the Vault. So keep help spreading the word about this channel by hitting that like button. Go ahead and hit the like button right now. Share this video with people, and also hit the subscribe. If you haven't already done that, subscribe to the channel. And don't forget, if you click on that black bell there, we will notify you as each and every episode goes live. And with that, we'll see you next time right here on Live from the Vault. We'll see you then.